Hello and welcome to the derivative session. I'm going to cover futures in this session. We'll look at the nature, structure, risk and return of the product along with its application to fund management. Futures are exchange-traded contracts, allowing access to an underlying asset's price and movements in this price without having to actually purchase the underlying physical. Let's take the FTSE 100 for instance. To save buying all the stocks individually in the index future gives full access to those stocks in one convenient way, through a futures contract. We can see in this slide the FTSE 100 index is priced at 7178. That is closely related to the price of the FTSE today. Futures all have delivery dates, traditionally March, June, Sep and Dec, meaning we can use this particular contract to gain access to the price movement of the FTSE until it expires, in this example, in December 17. The question is, do we think the FTSE will be higher than 7178 by December or lower? We take a view on movements and the person we trade with will take the opposite view. Over time, there will be a winner and a loser. At the time we decide to close the trade out, the profit or loss will be calculated by taking the price movement in ticks and multiplying the tick value, which we see as £10. We can close out the trade at any point in time. The exchange match us to a trader with the opposite deal. We can go long or short this contract to reflect our view of the market at a fraction of the price than buying up all of the shares physically. All we require is a deposit. This amount is to be paid to the exchange. It's called initial margin. A long future expressed the view of prices increasing, whilst a short future would represent an investment view of falling prices. As with conventional assets, the upside is unlimited, whilst the downside is limited to the price that you paid for the future, i.e. the market may fall down to zero. We see in this slide the underlying is now the 10-year German government bond, the Bund. In the same way, we can gain access to this market by either buying the actual physical bonds or by going long a Bund future. Dynamics work in the same way as a physical bond. If yields increase, the price of the bond future will fall and vice versa. Because of this relationship, we use bond futures to gain or reduce duration in a fund. By going long a bond future, we are gaining duration in the same way as buying the physical bond. By going short the future, we are reducing duration, as the price will fall as the yield rises, and thus being short, we're making a profit on the contract as it decreases in value. It's much more cost effective to manage duration with futures than with physical bonds, as we only require an initial margin as a deposit, meaning we can access the market quickly and execute our view in a matter of seconds rather than days. It is much easier to reflect a view of yields rising with futures than it is to go short cash bonds that you may own already. To reduce counterparty risk, the exchange asks both parties to settle their trades on a daily basis. Assuming prices have moved over the course of the day, there will be a winner and a loser, and thus a payment is made from one to the other. This limits the risk the exchange takes from both parties. Although consider you are on the losing side for an awfully long time, futures can be quite cash intensive, as payments will be made each day until you become the winner of that trade. This daily movement of cash is referred to as variation margin.